Let's get some ideas in international stocks. Of course, we've heard a lot about a rotation into European markets amid disquiet over policy volatility in Washington, let's put it that way. We're joined by Ric Palombi, Senior Portfolio Manager covering international equities and alternative income at CWB Wealth. Thanks very much for coming on the show.
Great to be here, Andrew. Thank you.
Let's jump in. BNP Paribas, the French financial services giant. What attracts you to that stock?
Well, it's one of the largest corporate lenders and investment banks in Europe, and they stand to benefit from the large infrastructure and defense spending in Germany. We think there's going to be corporate lending expansion there and EPS upgrades. Not talked about a lot, but we also see a capital markets union optimism coming into Europe. Europe has about 33 trillion in savings that hopefully they can get into some higher yielding securitization where BNP can perform and do well. So we see a bright upside for BNP.
And so 6 times forward PE and 0.7 times price to book. How would that compare with banks in the US and globally?
Well, I mean, it's trading at a pretty significant discount when you're talking about JP Morgan, the JP Morgans of the world. So, yeah, we see at 0.7 below book, a 10% return on tangible equity, which is expected to increase. Dividend yield of about 8%. If you include buybacks, we see a capital return of 10. So, we see pretty significant upside from these levels into the 90 euro area. So, we're pretty excited about this bank for sure.
Your next idea is called Heidelberg Materials. What are they? What do they do?
Heidelberg is a leading supplier of cement and aggregates in Europe, and one of the few ways that an investor here in North America can play this theme, since there are no more large cap sort of cement companies in North America. So when we think about what we're seeing there, it's a consolidated and disciplined industry now, and Europe has benefited from favorable pricing environment driven by rising carbon costs and pricing. So we see pretty significant upside again from the German debt brake loosening up, but they also have some exposure in North America. But since cement is locally produced, they don't have a lot of tariffs. So we see some pretty significant upside here as well. Double-digit EPS growth, return on invested capital of 12 or 13%. Currently trades at about 8 times EBITDA, 12 times PE. So we see this in the 200 euro area here. So we're, again, another one that kind of take advantage of. That's kind of a unique play.
And we're hearing about, defense spending in Europe. I mean, concrete doesn't leap to mind, but I guess if they are going to be building new facilities, barracks, training grounds, they're going to need construction materials.
Absolutely. 8% EPS in Germany. So there's exposure there, and we're pretty excited about this opportunity as well.
And then your final idea, I think it's another German company, Lanxess.
Yes, Lanxess is kind of flies under the radar. It is really a specialty chemical company in the smaller cap, mid cap range. It does invest advanced industrial intermediaries and special additives. It's been under pressure as well as others in the sector with the Russian-Ukrainian war and the Russian gas supplies into Germany. But here, the market narrative is that investors believe that it will not survive this cyclical downturn. We think differently. It's down over 70%, but it's priced for permanent impairment. But we just don't see it. They are doing the right things in terms of the management. It's very high quality, an agile management that's been doing M&A and asset disposals. And a key thing here is that their debt is non-recourse, so there's lots of opportunity for them to generate free cash flow once the market stabilize, and it trades at basically 0.46 or half a book. So you're picking up these assets for 50 cents on the dollar. So again, we're pretty excited about this one as well. There's some activist presence with David Einhorn in here. So we're thinking that this has pretty significant upside. Just to get to book, it's over 100% upside here. So this is the one that's kind of a little bit off the radar, but we see pretty good opportunities in this one as well.
But debt has been giving some investors pause when it comes to this name.
It has. And again, when you dig into it, though, management's done a great job with the non-recourse debt. So the debt, it is on the balance sheet, but really, because it's non-recourse, it's very difficult to push this company into bankruptcy. So we're seeing a lot of opportunity there as well.
Ric, we're going to have to leave it there. Thank you very much indeed for joining us.
Thank you, Andrew. Really appreciate it.
Ric Palombi, Senior Portfolio Manager covering international equities and alternative income at CWB Wealth. Coming up,